Right, good afternoon, ladies and gentlemen. Slightly delayed start, but nonetheless welcome to the panel of one-handed economists, which is where you get to hear what actually to do with your portfolios, having heard all of the great background on the macro stories indifferently around the world. My name is Andy Hartwell, CEO of Quasar Financial Research, and a veteran of these conferences. This is now my fourth. Having done this panel at each of the last three conferences as well. And I'm joined today by some familiar faces and some new ones as well, to try to make sense of the investment world and, as I say, what to do with portfolios. Having spent most of my city career as an investment strategist, sometimes portfolio manager on the buy side and on the sell side, veteran of several global crises, with the stab wounds in my back to show for it. I have to say that this is probably one of the most puzzling times, perplexing times at which to be a portfolio manager. Because on the one hand, we've just enjoyed, apparently, a bull run in equities, or was it a recovery from the GFC, with a bull run genuinely still to come? How do we play the equity markets as we face normalizing rate cycles and yield curves and the threat, or is it a phantom, of returning inflation and the lack of a term premium in the yield curve? Over the weekend, I was reading something to try to help me fathom my own way through that, and came across a phrase which I think sums up this panel's task pretty well. Equities have found a flaw in the macro environment, but are still looking for a flaw in valuations. So do we now, as equity strategists and equity managers, simply close our eyes to the valuation story, which seems to be stretched, and particularly in the Western developed markets, and buy yesterday's winners, the tech sectors and other pro-cyclical? Or is it time to take a more defensive view, and particularly in different parts of the world? To try to answer those questions and to help you come to an answer, I'm joined today by Simon Goodfellow, founder of Harlin, also by Paul Wildman, Value Momentum, making his maiden outing on this panel. Welcome, Paul. And by Tim Hayes, the global strategist at Ned Davis. So I'm going to ask each of them to give you guys a 5 to 7 minute presentation of their views. I'll wave something at them if I think that they're in danger of straying over in time, because I'm aware that this session leads straight into lunch, and I've learnt many things over my years, including don't stand between an audience, a hungry audience, and lunchtime. So I will try to finish at 1 o'clock sharp, but in that remaining time to us now, I'll ask Simon to start us off with a presentation towards the questions that are on your mind. Thanks a lot.
The moment of truth. Let's see if the technology actually works. Yes, it does. Marvellous. Harlin Research, very, very short advert. On my stuff, you're not actually going to hear me talking about forecasts or valuation. It's not because we don't really like them. It's just lots and lots of other people do them, and so we do something different. Formally, we call ourselves a probability shop, but what that really means is that we are incredibly sensitive to the relationship between return and risk. And the question we ask all the time, literally every week, is, are you being paid enough of a premium to hold this asset? And we express that sort of premium in terms of excess volatility. So that's how we think about it. The benefit of this is that we spend far more time working out what investors should get rid of. And the mere fact that we are rotating these portfolios, frankly, more often than most other people do, gives us the opportunity to buy the things that we like, but much more importantly, we get rid of the things that aren't paying you their cost of risk. I'm going to confine my remarks to pan-European sectors. We do the same analysis on Japan, China, the US, and we actually split Europe between the UK and the Eurozone. Here is where we are, the squiggly lines. You can read at the bottom what the key is. The biggest single overweight we have in Europe at the moment is actually in small caps. To a certain extent, that is the replacement, if you like, for the tech sector, which doesn't really exist in Europe. The thing that I'm going to talk about exclusively today is those bottom four, which are the four defensive sectors: staples, healthcare, telecom, and utilities. And as you can see, those are really, really big underweights. And what I'm going to get across to you, I hope, in the next sort of 4 or 5 minutes, is just how big those underweights are. If I went all the way back to 1995, which is when our models really start, the line would look so squiggly that you wouldn't really get it. But the point I want to make is obviously the two bond boxes, telecom and utilities, are very, very close to their 12-year lows in terms of how we look at them, in terms of their attractiveness on a return per unit of risk basis. I have to make the very basic point that everything that we do comes out of observations that we make about the market. So if you collectively, as a group of investors, weren't doing this, then our charts would be different. I'm not going to call it reflexivity in the way that George Soros was, but it's not a bad concept. Everybody hates telecom and utilities, and everybody hates healthcare almost as much, and staples not quite as much. But broadly speaking, everybody hates defensives. And it's such a consensus call that what I've noticed in the last few months is nobody even bothers to argue the case for it. It's just assumed that everybody will be underweight the defensives. This is going all the way back to 1996. I've got one line here. As a group, on our methodology, investors are the most underweight they have ever been on defensives as a group in pan-Europe. This is an absolutely massive consensus. Now, you all probably agree with it, but my point is you've all agreed with it for really quite a long time already, and we're going to do the time dimension in a minute. I want to compare that with the US. So it's exactly the same definition: telecom, staples, healthcare, and utilities. We're not quite as underweight in the US. We did get to an all-time low back in early 2017. In the most recent sell-off, and in fact, actually in the bull market, more particularly that went for it, we actually didn't disinvest any further from defensives in the US. So you don't actually need a big market sell-off to increase your weighting in defensives. And the reason I say that is we've just had the worked example. The US investor base is already saying, hang on a minute, I know we don't like them, but at some stage we're going to have to tail back our dislike of them. And the final point I want to sort of get across is persistence. And this is actually a very difficult thing to measure. So what we do is we actually look at the number of consecutive weeks any one of the bottom 3 sectors has been ranked in the bottom 3. And then we just look at the bottom 3 and take a simple average. It's a reasonably good measure of persistence. Fact number 1, and this is the bottom left-hand chart, persistence at the top of the table is just not as strong and never has been as persistence at the bottom of the table. So in English, what that means is we tend to stay, as an investor base, we tend to dislike the things that we hate for longer than we like the things that we like, which is actually quite an important asymmetry. But more importantly, as those 3 numbers at the top, the current grouping of telecom, utilities and healthcare has on average been in the bottom 3 for 31 weeks now. The median for this observation going back 22 years is 15.6, and the maximum, the worst combination of any 3 sectors ever in the history of the European model is 47 weeks, which takes us through to the 2nd week of June. Now, I'm not saying we can't set a record, but what I am saying is that this infinite sort of horizon through to sort of middle of 2019, without a significant sector rotation, which is implied by the sort of the benign top-down view that everybody has, that would truly, truly be record-breaking. And I don't buy it. I think we probably do set a record, but I don't think we set a record by very much. And at some stage, you are going to have to own more of the defensives than you currently do. Why? Because absolutely everybody is underweight, and when they move, boy, it will be a very big move and a very quick move. I don't know when, but I do know it's going to happen.
Great, thank you so much. Simon, we'll come back on some of the points raised by Simon in the Q&A and discussion session after all 3 of the panellists have had a chance to set out their stalls. So next up to do just that is Paul Wildman from Value Momentum, making the maiden appearance at this conference. Are you comfortable with the technology there, Paul?
Not really. Just
The cavalry's coming.
still on your slides there. Okay. So none of these are mine. Oh, there we go. Good afternoon, everybody. My name's Paul Wildman, co-founder of Value Momentum Research. After many years in the business of buy side, sell side, myself and a couple of colleagues decided to branch out alone, and with the help of Avalon Capital, we managed to put together what we think is quite a unique equity product for institutional investors. So what do? We don't believe in 100-page research notes. Rather, we analyse lots of earnings data. Earnings is our thing, and that's what we look at. And we use that to hopefully come up with interesting observations. And so there's 2 props that we look at. The first area is valuation, and we look at what we call trend PE. So what you're looking at there is Sandvik over the last 20 years, and that's not on spot PE, that's on trend. So what do? We take the earnings series, we look at gap earnings, we take the earnings series over 20 years, find out what we think is a reasonable base, and then model a trend earnings growth rate. And for Sandvik, we think it's 6.5%. We then stick the price over that trend EPS, and you get a trend PE. And hopefully, as you can see, it's a good mean reverter, and there's been periods of massive overvaluation, and then big opportunities with huge undervaluation, the latest being early 2016. The second part is momentum. Things can say expensive or cheap. For a long time, you need a catalyst, and that's where we use momentum, and we're talking about earnings momentum, not price momentum. So this is the relative earnings momentum chart for Sandvik. So what you're looking at here is 3 years, every bar is 1 month. And what we're doing is we're looking at, it's always 12 months forward, rolling earnings estimates, again it's gap, and we look at what the earnings are now, FY1, FY2 blended, and then we look at what that estimate was 1 month ago, 3 months ago, and 6 months ago. And so we're looking for the rate of change. Just for visuals, any stock every stock gets a number for every month, and you rank each stock from 0 to 100. green bars above the 50th percentile and yellow are below. So, marrying these two together, hopefully, you get decent results. And as I said, at the start of 2016, you saw this big undervaluation. And as you go through the months, hopefully you can see on the right-hand side, the yellow bars start to rise, which means the pace of earnings, relative earnings downgrades was slowing, which in itself is interesting. And then when you go above the 50th percentile in July of 2016, it's obviously getting relative revisions above the market, and that's we would have been interested in, and we were telling clients. And if you open a position then, over time, you would have outperformed the stock 600 by nearly 60%. So it does work, and obviously we're looking conversely the other way. When things get very expensive and revisions are rolling, we'll be advising clients to get out. So just going to different markets, just looking at USA, what we can do is aggregate. And so that's the aggregate revision for the US over nearly 20 years. And the very interesting stark thing at the moment, it's the highest pace of upgrades in that 20-year period, plus 12%. Obviously, the tax change is a big thing, but also you've got a market which is growing at 3%. From that aggregate, we can break that down into sectors, so we can see what makes up that plus 12%. So the biggest contributors, general financials, oil and gas producers and banks, real estate, Simon was talking about, real estate negative, and the interesting, I guess, is hardware and software, which was the biggest contributors a few months ago. Still positive, but that has declined. But obviously we do know that the tax implications for technology companies are less than they are for most of the other companies. Moving on to Europe, the aggregate revision is plus 4% now. It was 1.2. So it's had a nice jump. And again, breaking it down into the sectors, oil and gas, once again, autos, which is in stark contrast to the US, and the biggest negatives, utilities and pharmaceuticals. So backing up again what Simon was saying about those sectors. And then the UK, it's 5.4% at the moment versus 2.5%. And I mean, the interesting thing about this chart is what's happened with a currency. You can see where the referendum happened, you get the massive spike, and then as sterling has started to appreciate against other countries, it's come back a little bit. But breaking it down to the sectors, I mean, oil and gas is nearly 30% of that plus 5.4% revision, and banks are very strong, and obviously the miners, and once again, pharma and utilities are big negatives. So just to sort of wrap up, we track this, and we can see where things are changing. So on the left-hand side, you can see how banks in September were the biggest contributors in Europe, and they're still positive, but they're nowhere near as positive as they were. And the big move in oil and gas from minus 7% to nearly plus 11% now. Again, on the right-hand side, I've mentioned the tech sector, so that was nearly 13%. It's now 5%, and you've seen a big shift in oil and gas. And just to finish off, we put these together. So this is just an example of a trend P on a sector. So we're looking at oil and gas. You can see the huge undervaluation over the 20-year period, and that very interesting increase in relative revisions. And as I've just said, that's been seen across the board. So thanks very much for your time. That's it.
Paul, thank you very much indeed. What a timely maiden intervention as well. Thank you very much for that, keeping us to time. And then handing over now to Tim from Ned Davis. Tim.
All right. So Actually, I look at a lot of the similar things that both Simon and Paul look at. The difference, I'd say, about our approach is we tend to be more trend sensitive, and we are going to stay with trends and not try to get off the trend too soon, because that's when we often say the big money's made on the big move. So right now, I'd start with this chart here, and I also explain that we use the MSCI Universe, the All Country World Index sectors. So we also want to understand what the weightings are within these sectors. And financials and tech, I show here, have the most weights within the All Country World Index. And this has been a really, what I try to do with the sector work is I look at this in conjunction with our top-down asset allocation work, which I talked about in an earlier session. And that helps us because if we see a fundamentally strong environment with global breadth that's suggesting the uptrend is well intact, then we might want to think, well, maybe this defensive underperformance is further to go. Because that is the question. I agree with Simon. Defensive at some point will be the place to go. But the question is, when is that going to be? So what I show here is that it was really around the middle of 2016, after Brexit, and after, right around here, after Brexit is really when the global economy started to come back, what we heard often described as this globally synchronized economic recovery. And that's when yields started moving higher, and that's when financials really started to show better relative strength. You can see here the weight within the All Country World Index is now 19%. Tech is 18%, and the difference with tech is it's been a sustainable leader throughout this time. So if we think about that, tech, and I talked about this a little bit earlier, in that we've been in a secular bull market since early 2009, that really, since what often happens is that the leadership will reassert itself. So we had the sell-off, and since the sell-off, tech's already up 10%. Year to date, tech's been the strongest sector. If we look at 6-month performance, tech's been the strongest sector. Last year, tech. Go back to the cyclical bottom in 2011, it's been tech, and go back to the secular bottom, it's been tech. So it's been really a consistent message of outperformance, and we want to be careful to fight that trend. So here I show the correlations across the relative strength correlation to the All Country World Index. So this is helpful because it can tell us if our analysis of the broad market is positive for overweight equities, well, then that positive correlator we can expect to maybe continue to outperform. And this has clearly been technology. And actually, the change of the correlation has picked up. Financials had been the strongest a year ago. They've actually come back a bit. But look at the bottom here. Telecom, real estate, consumer staples, utilities, strong inverse correlations. It really just shows how decisive this defensive underperformance is when the market's going up. I'd also point out that when we had the sell-off in early February, the defensive sectors had just very limited run of outperformance. And this was a sign that maybe the trend was going to kind of reassert itself once the market had bottomed out, which is what has happened. In fact, for the weakest sectors since the rally started, since the bottom of the market earlier in February, have been energy, real estate, telecom, and staples. So that's another consistency. But we do want to also recognize the valuation. So what we do here is we look at the median earnings yield among stocks within each sector. That way we take away that sort of cap-weighted influence. So you don't have the big stocks dominating, which would be the case with tech in particular. So what I point out here is tech was a year ago, looked much better on a valuation basis. It's come down to 3.8, but that's really about in line with its historical median. So tech doesn't look wildly expensive yet. Meanwhile, financials, clearly the cheapest sector, despite the fact that they've been outperforming, 6.7% earnings yield. That's right in line with historical norm. And yet, notice how utilities, while they look better on a relative valuation basis, they're actually more expensive than they normally would be historically. So, I don't think we have a decisive. I would be much more bullish on defensive sectors if we started to see the defensive sectors broadly cheap, and then the leading sectors, financials and tech, broadly expensive. But that's not the case yet. We also want to keep an eye on the earnings. So here what I show is, the change in the earnings, and this has implications for a sector like energy, which, are the earnings going to continue to come through? 1,800% growth in earnings from negative earnings depressed levels, has had an impact on the earnings yield. So this shows how the 12-month point change in earnings yield has picked up. Meanwhile, at the bottom, notice how utility sector earnings low, healthcare, telecom. So again, another message confirming that we don't yet have a compelling case to get into the defensive sectors. So I guess my time probably is running out, right?
Go
Okay.
well. Yeah.
So just to summarize, I would say stay with again, financials and tech together are almost 40% of all country world market cap. I would stay with those leading sectors. You get sort of a value growth mix there as well. And avoid the defensives, but let's watch some of these things as the market, if we do keep the rallying the shares, as I think we will, maybe things start to look a little different as we get closer to a cyclical bear market in equities. And that's something we'll be watching out for later this year and next year. Thanks.
Great. Tim, thank you so much. And to the other panelists, all of whom have left us 10 minutes or so before the break for lunch. Let me just start off whilst you guys think of some questions and the roving microphones, which will appear. There's one to the right of my right on the auditorium, about halfway up as well. One of the things that struck me, guys, in listening to you all is this idea around the defensives, not yet, as well. And one thing that was silent in the conversation was any differences that you're seeing now at regional level. Paul, for example, spoke around the earnings changes around the US, the UK, and in Europe. Oil and gas are everywhere, upgrades, but differences between financials, autos, and mining in those different regions. Anything further out? So if we're still cyclical, if we're still pro-cyclical, if we're still buying those tech stocks and the rest of it as well, are we still buying EM as well on the back of that? So maybe that's just something that you guys can comment on quickly whilst the colleagues here in the hall contemplate their first question.
Yeah, I mean, I'll just start. I'll make one point about that. I've been talking about technology quite a bit, and we break the world into 7 regions: Europe, ex-UK, UK, Pacific, Japan, emerging markets, Canada. And when we do that, we find that 2 regions where tech is most dominant is the US and emerging markets. So if tech's going to do well, that is another consistency. We talked in an earlier session about emerging markets as being a steady outperformer. That Tencent, Alibaba, plus all the FANG stocks pretty much dominate the top 10 market cap of the All Country World Index. More than 10% of market cap is in those 10 stocks, which are Chinese and US. So, and but that could eventually get us into trouble if the market gets too concentrated in these stocks, and we're vulnerable to some kind of earnings disappointments, and then things start to look a lot different.
Yeah, no sign of that just yet. I'm interested to know what the signals are, by the way, guys,
Okay.
as to what we need to look out for as well. Paul, anything on those sort of general framing points around the rotation to defences one day, maybe, whatever? And
Yeah, I mean, I think the things, as I said in the slides, was the pharmaceuticals very poor in Europe and UK, but that's the sector we're watching, just like we saw oils last September being the biggest negative. When you start to see that change is when we start to get interested, and we'll be telling our clients. So at the moment, it's a sector we're watching. I'm less interested in utilities. I just think in this increasing yield environment, which I do believe in, I don't think you go anywhere near utilities. It's certainly in the States, because I think certainly on trend PE, they're very, very, very expensive. I also worry about chemicals because it seems to me on trend PE there's massive overvaluation in the States and also in Europe. And I know there's a capacity argument, and they're more specialist. However, they are, and yes, they're faster growing companies than they used to be, but I feel that they are getting very expensive, and relative revisions are starting to roll off. So that is a sector, and you can call it cyclical sector, that's starting to go, in my opinion. So that's another sector I'm watching.
And Simon, you introduced the concept of the defences and so on,
Right.
Not quite yet, but you also talked about persistence and records and maybe getting to a record, but it wouldn't be a big one.
Yeah, I mean,
Are you rotating this year?
Well, I don't know. Again, I should just specify that our horizon tends to be slightly shorter than everybody else's. We really operate in a sort of 8 to 16 week time horizon. So it's enough warning to get out if you need to get out. But other people do the sort of the 6 to 18 month view. So great. I don't have to compete with them. So. Just a couple of things on defensives. Firstly, not all the world is quite as defensive as we think it is. I mean, in China, actually, staples in healthcare until relatively recently were really in the sort of certainly in the top half of the table. And in Japan, and this was one of the really interesting things that happened actually slightly before the sell-off, is we did actually see the first beginnings of some sort of rotation away from cyclical exposure into defensives. The point about setting records and the 2nd or 3rd week of June or whatever, I'm not hung up on timescales. It's really a story about event risk. And the thing I was listening to, we were forced to listen to the earlier panel, and they all came up with these really quite doomsday scenarios about a trade war being a high probability event. And that's certainly not in the market price at the moment. So give me something that triggers a high probability, a trade war, give it to me in the run up to the midterm elections, which I think, if that's your scenario, then the midterm elections is when that's really going to come out. Give me that scenario and then tell me that defensives aren't going to outperform. I just would have, and tell me that bond yields are going to go up. I mean, it doesn't seem to me that we are in any way taking account of some of these geopolitical event risk downsides in our conventional work. And that's all I'm really pointing to, is that we are completely prepped for this sort of shock. I can't give you the trigger, I can't give you the timing, but everybody is positioned the other way, and that is what is starting to scare me. That's it.
Very honest. Thank you, Simon. No less than I would expect.
Tech if you want me to.
No, absolutely. Okay, over to you, the audience. Questions?
Global economy, obviously.
Anybody
China
with a question for the panel? Everybody happy with their portfolio construction?
Offsettings, or you can say it's like the risk to your
I
forecast.
can't hear
Is
or
there any
see.
sort
Where's
of
that question
upside
coming
risk
from?
to your forecast?
Sorry, I didn't hear it.
Can you put your... Oh, it's over here? Thank you so much. Thank you.
If we think about sort of an EY framework and sort of implied cost of capital and what's the right number for banks, we look around the world at how banks are valued. When we head to Japan, can you help us with the conundrum of how should we actually think about the valuation of Japanese banks?
Who wants to take that?
Well, I don't do valuation at all.
Thoughts on Japanese banks?
Again, let me broaden it slightly to financials in general, and then tell me if you think this is relevant. All three of us in our presentations or in the discussion beforehand fingered real estate as one of the big sells out here in a rising yield environment. And throughout my career, every single time it has been real estate that has killed the financials sector. And it's just a question of almost a relative degrees of zombiness after the crash. Now, I am told that banks are better capitalized. I am told that they are less sensitive to all these events. I'm told, et cetera, and I go, well, maybe. I'm told that Japanese financials have shaken their exposure to real estate lending. I don't know. We find out when the bathwater gets let out. That's my point on actually all financials at the moment. I'm not super bearish on them, but I am super bearish on real estate, and I know that has an impact eventually on financials.
Jim?
Yeah, I'll address that. I just actually had skipped over one of the slides.
Here's one he made earlier. Absolutely brilliant timing.
So this was, I wanted to just on the topic of financials to make a point that I think we should keep in mind here is that if you look at this table here, what I'm showing here is the correlations of the different sectors to a global aggregate bond yield. So this is much broader than just looking at the 10-year treasury. And notice how the correlation for financials clearly far and away the strongest. And then at the bottom, to Paul's point, utilities now are competing against interest rates for yield. But the point is, this, we forget that back in the 90s, financials were inversely correlated and when we were at a much different inflationary environment. So what I'll be watching here, and I'm looking at this for the broad market as well, is when bond yields, this correlations between the aggregate bond yield and the all country world index, when those interest rate correlation starts to fall and actually turn negative, which it has started to do using shorter term correlations, that's going to start to tell us that this rising yield environment is going to have an impact on the broad market. Now, if we think about financials have the most weight in the index, have this positive correlations, financials could then look pretty risky if they start to lose this positive correlation in a rising rate environment. So I keep that in mind. That could make the valuations I talked about earlier look less positive as an influence. So now watch the relationship between the correlations and the interest rates and the sector correlations.
Tim, sorry, quick question. You basically, when you finish your intervention, you basically said that you are expecting a cyclical bear market in the second half of the year, no?
Well, yeah, let me clarify that. What I'm saying is right now we're in a cyclical bull market, but we'll be, I think, as we get toward the end of this year and into next year, quite likely all the cycles, the economic cycle, the earnings cycle, the interest rate cycle will be more mature. The valuations could be more stretched. The market could be more at risk of a cyclical bear. So I would keep that in mind in terms of thinking about defensive sectors.
The question is basically, you have rising rates, commodities rising, low unemployment, everything basically looks aligned. There hasn't been any rotations, you know. In fact, everybody has basically stayed exactly the same in terms of positioning, right? And if this were to happen, why the second part of the year and not now? You know, you basically have Fed chairman changing the bias differently. You know, you can end up with the money market yielding 3%, you see. Why basically stay invested in risky assets when you can basically take the risk-free rate at 3%? So why not now? Why do you have to wait 6 months for a cyclical bear market to start?
Yeah, it could very well happen right away. What we do, though, is we have models and our indicators, and they're not telling us that the market is rolling over yet. What they're telling us, actually, that we've corrected the dangerous situation with January was that the valuations got stretched with the PE got above 23 on the world index. Sentiment got very optimistic, market got overbought. Well, we had the sell-off, and it actually brought the PE down to the lowest levels since mid-1986. It brought the optimism down to pessimism, got the market oversold. So it sort of was a healthy correction in that sense, and it hasn't caused any trend damage, and the fundamentals are the same as they were a month ago. But if there's, the markets are always discounting the future, and there could be something out there, and it will start to get picked up by our breadth indicators and our trend indicators, and the defensive leadership at that point might start to show up. So I'm using actually the defensive leadership together with the top-down work and to sort of for confirmation or non-confirmation.
How do you guys at Ned Davis explain this dollar weakness, on the back of this amazing performance of the U.S. economy?
Yeah, I talked about that in an earlier session. Basically, I won't go into all the details, but the bottom line of it was that in a negative real rate environment, the markets are more focused on relative economic growth. And the fact is the U.S. has gotten relatively mature. Also, the U.S. has now a deficit issue, a big deficit issue. The deficit was already widening, and now we have all this tax reform that's going to add to that deficit. So that seems to be what the market's been more focused on.
Okay, maybe one more question with your indulgence. Here we go.
Yeah, thanks. This is just more of a general question on frameworks over here, because global sector allocations, the way it's done over here, I mean, how relevant is this right now? You have some global sectors and they remain global sectors, but, take banking, it's pretty specific to regions. And then take technology, it's come up a couple of times. I mean, the way the semiconductors in that space act and behave versus the software companies. You have many local and global sort of players over there as well. I mean, are we just not looking at this the right way to begin with?
That's an interesting challenge to this whole panel. I'm looking forward to the fifth one, by the way, next year after Global Sector Allocation Plan. But on the particular, Simon.
Well, let me take that. I'm absolutely on the same camp as you. You noticed I talked about pan-European sector allocation. I'm even slightly uncomfortable about doing that. I'd much prefer to talk about UK and Eurozone. I have never believed that global sector allocation has anything interesting to say. I mean, yes, energy, yes, financials, yes, tech on occasions, but no, please keep it local. I may disagree with the other panel, but I'm a local guy, not a global guy.
Paul?
No, I agree with Simon. I think there are sectors that obviously are global, oils and financials, as you said, but you've got to be careful. I think industrials on the whole, you could probably stick in a global camp, but banking is very domestic. I think you've got to break it down to the market. As I showed in my presentation, we like to look at the market and then what's driving things in that market. And it might be a global thematic for some sectors, but certainly not all.
Yeah, Tim?
Yeah, no, I'd agree with that. I mean, certainly some sectors are more global, and we have to remember Europe, for example, almost no tech at all. I think you mentioned that in your presentation. You don't include the tech sector. So, we really do kind of have to do the overlay with regions and sectors. Europe, very heavy on consumer also, and the UK as well, heavy on the more resource sectors and consumer to an extent. So, I would agree with those points.
And I think just to conclude this session as well, to make the point that, absolutely right, the existence of a truly global sector and universally so around, to allow you to run your portfolios in that way doesn't exist in sufficient number. But this panel's task is to look around the world, to look around the globe at different sectors, and perhaps that helps to frame it a little better. And to put the panelists on the spot, just as we break for lunch, I promised that this was the one-handed economist panel, to leave you something actually to do with portfolios before you go away. So I invite each of you to just tell our audience your top buy, top sell, whether it's sector, regional level, whatever, around the globe. Simon.
Right.
Today, by the way, today.
Today, okay, so I'm actually going to stick with my model and stick in pan-Europe. We still like the growth style in Europe. It's earlier so you can't buy technology in Europe because it doesn't exist. So you do the next best thing, which is you bias your allocation to small caps, and I mean a very big bias to small caps. And the thing I'm getting worried about in Europe is industrials. It's partly Brexit, it's partly trade wars, and it's above all the euro, which really does horrible things to German industry and Dutch industry for that matter.
Very good. Thank you. Paul?
I would stick to what we see in our work, and if you're talking global sectors, we've just gone through that. Oils flags up in virtually every market as being very positive, and it's come through from a very, very cheap valuation. I mean, you have to go back to probably 1998 when the oil price was $10. So the equivalent, we were down there. Obviously, we've had a big move. So I would stick with oils. I think that will continue. On the sells, as I said, in the US and Japan, chemicals look dangerous to me. And the other thing I'll say quickly is aerospace and defence in the US as well. Very, very, very expensive. Everyone just thinks the budget's going to keep going, keep buying these things. It's dangerous. So we'll be watching for the revisions to go on aerospace and defence.
Red warning from the Equity Met Office on that. Thank you. Tim?
Yeah, I'd say just following up on what I was talking about earlier. I've been talking about technology. We've had a sell-off, probably time to get back into the ongoing leaders. Where are we going to see tech outperform? Well, we talked about emerging markets, and tech's the biggest sector in emerging market index at a time when dollar weakness is also bullish for emerging markets. So I think EM tech looks interesting. And then on the sell side, probably utilities now competing with rising 10-year treasury yields is a problem at a time when the U.S., the U.S. markets participating in this global recovery. So I'd probably say in the sell side, U.S. utilities, be bearish there and bullish on emerging market tech. Again, for a trade, 3 to 6 months, maybe longer.
That's great. Gentlemen, thank you very much indeed. Ladies and gentlemen, on behalf of you all, may I thank the panel and ask you to show your appreciation for them in a way. Thank you.